Question 1. The performance metrics show that a new cloud-based platform for administering health benefits offers significant cost savings and enhanced user experience, but the vendor's standard contract does not explicitly mention HIPAA compliance or include a business associate agreement. As a certified employee benefits specialist, CEBS, responsible for selecting this platform, which approach best aligns with regulatory requirements and professional best practices for safeguarding participant data. Option A. Implement the platform and request the vendor to provide a BAA only if a data breach occurs, as proactive contractual measures may be overly burdensome. Option B. Negotiate with the vendor to include a comprehensive business associate agreement, BA, that clearly outlines their responsibilities for protecting protected health information, FI, and verify their adherence to HIPAA security rule standards through independent audits or certifications. Option C. Proceed with the platform, assuming the vendor's general security measures are sufficient and that a separate BAA is not strictly necessary if the platform is designed for healthcare data. Option D. Select a different, more expensive cloud platform that explicitly advertises HIPAA compliance and includes a BAA in its standard offering, even if it means sacrificing some of the cost savings and user experience benefits. The correct answer is C. Proceed with the platform, assuming the vendor's general security measures are sufficient and that a separate BAA is not strictly necessary if the platform is designed for healthcare data. Explanation. This scenario is professionally challenging because it requires a benefits administrator to balance the operational efficiencies offered by cloud computing with the stringent data privacy and security obligations mandated by U.S. federal law, specifically ERISA and HIPAA, as they apply to employee benefit plans. The administrator must ensure that any cloud service provider can meet these legal requirements to protect sensitive participant information. The correct approach involves a thorough due diligence process that specifically assesses the cloud service provider's compliance with HIPAA security rule and business associate agreement (BA) requirements. This includes verifying the provider's security controls, data encryption practices, access management protocols, and their willingness to enter into a BAA that clearly defines responsibilities for protecting protected health information (FI). This approach is best professional practice because it directly addresses the legal and ethical obligations to safeguard participant data, as required by HIPAA and ERISA. A BAA is a critical legal document that ensures the vendor understands and agrees to its obligations regarding PHI. An incorrect approach that focuses solely on cost savings without verifying security and compliance measures fails to meet the fiduciary duties imposed by ERISA and the privacy mandates of HIPAA. This oversight can lead to significant data breaches, regulatory penalties, and loss of participant trust. Another incorrect approach that relies on the cloud provider's general assurances of security without specific, verifiable evidence or a BAA is insufficient. General assurances do not constitute a legally binding commitment to protect PHI and do not satisfy the requirements for a covered entity to ensure its business associates are compliant. A third incorrect approach that assumes all cloud providers are inherently compliant with HIPAA due to their nature overlooks the specific requirements for a BAA and the need for a covered entity to actively assess a business associate's security posture. Compliance is not automatic. It requires active engagement and contractual agreements. Professionals should employ a decision-making framework that prioritizes regulatory compliance and data security. This involves 1. Identifying all applicable regulations ERISA HIPAA. 2. Understanding the specific requirements of these regulations regarding data handling and vendor management. 3. Conducting comprehensive due diligence on potential vendors, focusing on their security certifications, audit reports, and willingness to enter into appropriate agreements, like a BAA. 4. Documenting the entire process and the rationale for vendor selection. Question 2. Assessment of the most appropriate cost accounting approach for allocating administrative expenses within a multi-employer defined contribution plan, considering the fiduciary responsibilities under ERISA and the need for transparent financial reporting, would involve evaluating which of the following methodologies. Option A. Allocating administrative costs by arbitrarily assigning a uniform amount to each plan segment based on administrative convenience. Option B. Allocating administrative costs by deferring a portion of current administrative expenses to future periods to reduce immediate reported costs. Option C. Allocating administrative costs using a simple, fixed percentage of each plan segment's total assets, irrespective of the actual administrative effort. Option D. Allocating administrative costs based on a detailed analysis of the specific services provided to each plan segment and the resources consumed by those services. Correct answer is D. Allocating administrative costs based on a detailed analysis of the specific services provided to each plan segment and the resources consumed by those services. Explanation: this scenario is professionally challenging because it requires a benefits administrator to balance the fiduciary duty to act in the best interest of plan participants with the practical realities of managing plan expenses. The administrator must ensure that the cost accounting methods used are not only efficient, but also transparent and compliant with ERISA reporting and disclosure requirements. The core challenge lies in selecting an approach that accurately reflects the true cost of administering the plan, without creating undue administrative burdens or misleading participants about the plan's financial health. The correct approach involves allocating administrative costs based on a reasonable and consistent methodology that directly relates to the services provided to the plan. This ensures that costs are borne by the plan in a manner that reflects the benefit received, aligning with ERISA prudence and loyalty standards. Specifically, ERISA Section 404(a)(1) requires fiduciaries to act solely in the interest of plan participants and beneficiaries, and with the care, skill, prudence, and diligence that a prudent person acting in like capacity and familiar with such matters would use. Cost accounting method that directly links expenses to plan services, such as allocating based on the number of participants served by a specific administrative function, or the complexity of services rendered to different plan types, fulfills this duty by ensuring fair allocation and preventing cross-subsidization. This method also supports accurate reporting on Form 5500 and other disclosures, which is mandated by ERISA. An incorrect approach that allocates administrative costs arbitrarily or based solely on convenience, without a clear link to services rendered, fails to meet the fiduciary standard. Such an approach could lead to participants in one plan subsidizing the administrative costs of another, violating the duty of loyalty. Furthermore, it could result in inaccurate financial reporting, potentially misleading participants and the Department of Labor, which is a violation of ERISA reporting and disclosure provisions. Another incorrect approach that allocates costs based on a fixed percentage of plan assets, regardless of the actual administrative effort expended, is also problematic. While seemingly simple, this method does not reflect the true cost of services and can disproportionately burden smaller plans or plans with high asset values but low administrative activity, or vice versa. This lack of proportionality can be seen as a failure to act prudently and in the best interest of all participants. A third incorrect approach that attempts to minimize reported administrative expenses by deferring or capitalizing costs that should be expensed in the current period would also be a regulatory failure. This misrepresents the plan's current financial performance and can violate accounting principles and ERISA requirements for accurate financial reporting. The professional decision-making process for similar situations should involve a thorough understanding of the plan's operations, the services provided by administrators, and the specific requirements of ERISA. Administrators should consult with qualified professionals, such as actuaries or ERISA counsel, to develop and implement a cost accounting methodology that is both compliant and equitable. Regular review and potential adjustment of the methodology are also crucial to ensure its continued appropriateness and adherence to regulatory standards. Question 3. Upon reviewing a plan sponsor's proposed selection of a mail-order pharmacy to reduce prescription drug costs, which of the following approaches best aligns with the fiduciary responsibilities and regulatory framework governing employee benefit plans in the United States? Option A. Choose a mail-order pharmacy that is conveniently located for the plan sponsor's administrative staff, even if it means slightly higher dispensing costs and less robust patient support. Option B. Prioritize the mail-order pharmacy that offers the lowest per-prescription dispensing fee, provided it can demonstrate basic licensure. Option C. Select a mail-order pharmacy based on a comprehensive evaluation of its adherence to all federal and state regulations, its dispensing accuracy and turnaround times, its patient counseling services, and its overall quality of care, in addition to cost-effectiveness. Option D. Rely on a recommendation from a single, well-known pharmaceutical wholesaler, without conducting independent verification of the mail-order pharmacy's operational compliance and service quality. The correct answer is B. Prioritize the mail-order pharmacy that offers the lowest per-prescription dispensing fee, provided it can demonstrate basic licensure. Explanation. This scenario presents a professional challenge for a CEBS professional tasked with evaluating a plan sponsor's approach to mail-order pharmacy services. The challenge lies in balancing cost containment objectives with the fiduciary duty to ensure plan participants have access to necessary medications in a safe and compliant manner. This requires a deep understanding of regulatory requirements, ethical considerations, and best practices in benefit plan administration. Careful judgment is needed to ensure that cost-saving measures do not compromise participant well-being or violate legal obligations. The correct approach involves a comprehensive evaluation of the mail-order pharmacy's compliance with all applicable federal and state laws, including those governing prescription drug dispensing, privacy, HIPAA, and non-discrimination. It also requires assessing the pharmacy's quality of service, dispensing accuracy, turnaround times, and the availability of patient counseling and support. This approach is considered best professional practice because it directly addresses the fiduciary responsibilities of plan administrators to act in the best interest of plan participants and beneficiaries, ensuring compliance with regulations like the Employee Retirement Income Security Act, ERISA, in the U.S., which mandates prudent management of plan assets and operations, is paramount. Furthermore, ethical considerations dictate that participant access to essential medications should not be unduly hindered by cost-saving initiatives. An incorrect approach that focuses solely on the lowest dispensing cost, without verifying the mail-order pharmacy's regulatory compliance and service quality, is professionally unacceptable. This failure would violate the fiduciary duty to manage plan assets prudently and in the best interest of participants. Such an approach could lead to dispensing errors, privacy breaches, or a lack of necessary patient support, all of which expose the plan sponsor to legal and financial risks. Another incorrect approach that prioritizes convenience for the plan sponsor over participant access or safety is also professionally flawed. This might involve selecting a mail-order pharmacy with limited dispensing hours or inadequate customer service, thereby creating barriers for participants to obtain their prescriptions. This neglects the responsibility to ensure that benefit plan operations are designed to serve the needs of the beneficiaries. Finally, an approach that relies on anecdotal evidence or the recommendations of a single vendor, without independent due diligence regarding the mail-order pharmacy's operational integrity and compliance record, is also problematic. This demonstrates a lack of the required professional skepticism and due diligence expected of a CEBS professional. The professional decision-making process for similar situations should involve a systematic review of potential vendors, including a thorough assessment of their regulatory compliance, operational capabilities, service standards, and cost-effectiveness. This process should be documented and should prioritize the long-term interests and well-being of plan participants while adhering to all legal and ethical obligations. Question 4. The evaluation methodology shows a need to assess the effectiveness of an accreditation program for retirement plan advisors. Which of the following approaches best demonstrates a commitment to ensuring the quality of advice provided to plan participants? Option A. Focusing solely on the total number of advisors who have successfully completed the accreditation program. Option B. Accepting anecdotal feedback from advisors regarding their positive experiences with the accreditation program. Option C. Reviewing the accreditation program's curriculum for alignment with current retirement plan, advising standards and examining post-accreditation performance data of advisors. Option D. Prioritizing the accreditation program based on the lowest cost to advisors. The correct answer is C. Reviewing the accreditation program's curriculum for alignment with current retirement plan, advising standards and examining post-accreditation performance data of advisors. Explanation. This scenario presents a professional challenge because it requires a benefits administrator to evaluate the effectiveness of an accreditation program for retirement plan advisors. The administrator must determine if the program truly enhances the quality of advice provided to plan participants, which directly impacts participant outcomes and the plan sponsor's fiduciary responsibilities. The challenge lies in moving beyond superficial metrics to assess the practical application of knowledge and ethical conduct, ensuring that accreditation translates into tangible benefits for those relying on the advisors. The correct approach involves a multifaceted evaluation that considers both the rigor of the accreditation program's curriculum and its demonstrated impact on advisor performance and participant satisfaction. This includes reviewing the program's content for alignment with current best practices in retirement plan advising, assessing the examination's difficulty and relevance, and examining post-accreditation performance data of advisors. This approach is justified by the fiduciary duty of plan sponsors and administrators to ensure that services provided to participants are of high quality and in their best interest. Regulatory frameworks, such as those governing ERISA in the U.S., emphasize the need for prudence and diligence in selecting and monitoring service providers. A comprehensive evaluation ensures that the accreditation serves as a reliable indicator of an advisor's competence and ethical commitment, thereby fulfilling these obligations. An incorrect approach would be to solely rely on the number of advisors who have achieved accreditation. This fails to assess the quality or depth of the accreditation, potentially overlooking programs with low standards or irrelevant content. Ethically, this could lead to the selection of advisors who are accredited but not truly qualified, potentially harming participants. Another incorrect approach would be to focus exclusively on the cost of the accreditation program. While cost is a factor, prioritizing it over the program's effectiveness and the advisor's competence would be a failure of due diligence. This approach neglects the primary objective of ensuring quality advice and could lead to the selection of less qualified advisors simply because their accreditation is cheaper, violating the principle of acting in the best interest of plan participants. A third incorrect approach would be to accept testimonials from advisors about the accreditation program without independent verification. While advisor feedback is valuable, it can be subjective and biased. Relying solely on such testimonials without examining objective performance data or the program's structure would not constitute a thorough evaluation and could overlook significant deficiencies in the accreditation process. The professional decision-making process for similar situations should involve a systematic and objective evaluation of any accreditation or certification program. This includes understanding the program's objectives, curriculum, assessment methods, and ongoing requirements. It also necessitates gathering data on the performance of accredited individuals and comparing it against established benchmarks or the performance of non-accredited individuals. The ultimate goal is to ensure that any accreditation serves as a meaningful indicator of competence and ethical conduct, thereby safeguarding the interests of plan participants and fulfilling fiduciary responsibilities. Question 5. Performance analysis shows that a significant portion of employees are enrolling in consumer-driven health plans, CDHP, without fully understanding the implications of higher deductibles and out-of-pocket maximums. As the plan administrator, what is the most appropriate approach to address this trend and ensure participants make informed enrollment decisions for the upcoming plan year? Option A. Develop and distribute comprehensive educational materials that clearly explain the mechanics of CDHP, including the role of high-deductible health plans, the function of tax-advantaged accounts like HSAS/HRAs, and the potential for both cost savings and increased out-of-pocket expenses, while also highlighting the importance of individual healthcare spending habits. Option B. Emphasize the administrative efficiencies and potential cost reductions for the employer that CDHP can provide, as this aligns with the company's overall benefit strategy. Option C. Provide a simplified overview of CDHP benefits, directing employees to the insurance carrier's website for detailed information on deductibles and out-of-pocket expenses. Option D. Focus communication efforts on the tax advantages associated with health savings accounts, HSA, and health reimbursement arrangements, HRA, offered within the CDHP, as this is often the primary driver for employee interest. The correct answer is A. Develop and distribute comprehensive educational materials that clearly explain the mechanics of CDHP, including the role of high-deductible health plans, the function of tax-advantaged accounts like HSAS/HRAs, and the potential for both cost savings and increased out-of-pocket expenses, while also highlighting the importance of individual healthcare spending habits. Explanation: this scenario is professionally challenging because it requires a benefits administrator to balance the fiduciary duty to act in the best interest of plan participants with the need to provide accurate and compliant information about a complex product. The administrator must ensure that the information provided about consumer-driven health plans, CDHP, is not misleading and adheres to all applicable regulations, particularly those governing health insurance and employee benefits communication. The core challenge lies in presenting the potential benefits and risks of CDHP in a way that is understandable to employees, enabling them to make informed enrollment decisions, while strictly adhering to ERISA disclosure requirements and any specific guidance from the Department of Labor (DOL) or the IRS regarding health plan communications. The correct approach involves providing a balanced overview of CDHP, clearly outlining both the potential cost savings through tax-advantaged accounts and the increased financial responsibility for healthcare expenses. This approach prioritizes participant education and informed decision-making, which aligns with the fiduciary responsibilities under ERISA. Specifically, it necessitates explaining the mechanics of health savings accounts, HSA, or health reimbursement arrangements, HRA, the role of high-deductible health plans, HDHP, and the implications of out-of-pocket maximums. This comprehensive disclosure ensures participants understand the trade-offs and can make a choice that best suits their individual healthcare needs and financial situations, thereby fulfilling the duty of care and loyalty owed to plan beneficiaries. An incorrect approach that focuses solely on the potential tax advantages of HSAs or HRAs without adequately explaining the higher deductibles and out-of-pocket costs would be misleading. This failure to present a complete picture violates the principle of providing accurate and non-misleading information, which is a cornerstone of ERISA disclosure requirements. Participants could enroll in a CDHP under the mistaken belief that it will always be cheaper, only to face significant financial burdens when they incur medical expenses that exceed the deductible. Such an omission would breach the fiduciary duty to act prudently and in the best interest of participants by not fully informing them of the risks. Another incorrect approach that emphasizes the administrative simplicity for the employer without detailing the participants' increased financial exposure is also problematic. While administrative ease might be a factor for the employer, the primary fiduciary responsibility is to the plan participants. Focusing on employer benefits over participant understanding and risk exposure neglects the core duty of care. This approach fails to equip participants with the necessary information to assess the financial implications of CDHP, potentially leading to adverse outcomes for them and exposing the plan sponsor to compliance risks. Professional decision-making process for similar situations should begin with a thorough understanding of the regulatory landscape, including ERISA, the Affordable Care Act (ACA), and any relevant IRS guidance on HSAs, HRA, and HDHP. The administrator should then develop communication materials that are clear, accurate, and balanced, presenting both the advantages and disadvantages of CDHP. This involves using plain language, providing concrete examples where appropriate, and ensuring that all disclosures meet legal requirements. Seeking legal counsel or consulting with benefits compliance experts can further mitigate risks and ensure that communications are both effective and compliant. The ultimate goal is to empower participants to make informed choices that align with their personal circumstances. Question 6. Implementation of a significant change to the company's 401(k) plan, including adjustments to investment options and contribution matching formulas, requires a comprehensive communication strategy to ensure all eligible employees understand the implications. Which of the following approaches best aligns with regulatory requirements and ethical best practices for employee communication regarding benefit plan changes? Option A. Send a brief email notification stating that plan documents have been updated on the company intranet, with a link to the full technical plan amendment document. Option B. Announce the changes verbally during a company-wide town hall meeting and provide a single, lengthy document containing all legalistic details of the amendments. Option C. Distribute a detailed summary document outlining all changes in plain language via company-wide email and host live, recorded webinars with Q&A sessions to address employee inquiries. Option D. Post a notice on the employee breakroom bulletin board, announcing the changes and directing employees to contact HR with any questions. The correct answer is C. Distribute a detailed summary document outlining all changes in plain language via company-wide email and host live, recorded webinars with Q&A sessions to address employee inquiries. Explanation. This scenario presents a common challenge for employee benefit specialists, ensuring effective communication of complex plan changes to a diverse workforce. The professional challenge lies in balancing the need for timely and accurate information with the varying levels of financial literacy and engagement among employees. A failure to communicate effectively can lead to confusion, distrust, and potential legal or regulatory noncompliance. Careful judgment is required to select communication methods that are accessible, understandable, and reach all intended recipients. The correct approach involves a multifaceted communication strategy that utilizes a variety of methods to cater to different learning styles and accessibility needs. This approach prioritizes clarity, accuracy, and accessibility, aligning with the fiduciary duty to act in the best interest of plan participants. Specifically, providing both written materials in plain language and offering opportunities for direct interaction, such as webinars or Q&A sessions, ensures that employees can receive and process information in a way that best suits them. This proactive and comprehensive strategy is crucial for meeting regulatory requirements for participant disclosure and fostering informed decision-making. An approach that relies solely on a single method, such as a brief email announcement, is professionally unacceptable. This fails to account for employees who may not regularly check their email or who may struggle to understand complex information presented in a concise format. It also risks violating regulatory disclosure requirements that mandate clear and understandable communication of plan changes. Another incorrect approach is to provide highly technical documentation without any supplementary explanation or interactive support. While this may contain all the legally required information, it is unlikely to be understood by the majority of plan participants, leading to confusion and potential misinterpretations. This demonstrates a lack of diligence in ensuring participants can comprehend the information, which is a core ethical and regulatory expectation. Finally, an approach that delays communication until the last possible moment is also professionally flawed. This creates unnecessary stress for employees and limits their ability to ask clarifying questions or make informed decisions before critical deadlines. Effective communication requires timely dissemination of information to allow for adequate understanding and action. The professional decision-making process for similar situations should involve a thorough assessment of the target audience, the nature of the information to be communicated, and the applicable regulatory disclosure requirements. A robust communication plan should then be developed, incorporating multiple channels and formats to ensure broad reach and comprehension. This plan should be reviewed for clarity, accuracy, and accessibility before implementation, with mechanisms for feedback and follow-up to address any employee concerns or misunderstandings. Question 7. Which approach would be most appropriate for a certified employee benefit specialist, CEBS, advising a plan sponsor on the implementation of new preventive care benefits, considering both cost-effectiveness and participant well-being within the U.S. regulatory framework? Option A. Prioritize the adoption of the least expensive preventive care services that offer a marginal improvement in health outcomes, regardless of long-term cost implications or participant engagement potential. Option B. Focus exclusively on services that demonstrably reduce immediate out-of-pocket expenses for participants, even if these services have limited impact on overall long-term healthcare utilization or cost for the plan. Option C. Implement a broad range of popular preventive care services based on industry trends, without detailed evaluation of their specific effectiveness or cost-benefit for the plan's population. Option D. Conduct a thorough cost-benefit analysis of various evidence-based preventive care interventions, assessing their potential impact on long-term healthcare costs, employee productivity, and participant health, while ensuring compliance with ERISA and other relevant regulations. The correct answer is A. Prioritize the adoption of the least expensive preventive care services that offer a marginal improvement in health outcomes, regardless of long-term cost implications or participant engagement potential. Explanation: this scenario presents a professional challenge because benefit plan sponsors are increasingly focused on cost containment while simultaneously seeking to improve employee health and productivity. Preventive care initiatives, while beneficial in the long run, often require upfront investment and careful design to demonstrate their value and ensure compliance with relevant regulations. The CEBS professional must balance fiduciary responsibilities to the plan sponsor with the ethical obligation to provide effective and compliant benefits to participants. Correct approach involves a comprehensive evaluation of various preventive care strategies, considering their potential impact on employee health outcomes, long-term cost savings, and alignment with the plan's overall objectives, while ensuring adherence to ERISA fiduciary duties. This includes a thorough analysis of the evidence supporting the effectiveness of proposed interventions, the administrative feasibility of implementation, and the potential for participant engagement. Regulatory compliance is paramount, ensuring that any recommended preventive care benefits do not discriminate and are offered in a manner consistent with the plan's terms and applicable laws. An incorrect approach would be to solely focus on the immediate cost of implementing a preventive care program without considering its potential long-term return on investment or its impact on employee well-being. This overlooks the fiduciary duty to act in the best interest of participants and beneficiaries, which includes promoting their health and reducing future healthcare expenditures. Another incorrect approach would be to adopt a preventive care strategy based on anecdotal evidence or popular trends without rigorous evaluation of its efficacy and cost-effectiveness. This could lead to the expenditure of plan assets on ineffective programs, violating the duty of prudence. Furthermore, implementing a program without ensuring it meets all legal and regulatory requirements, such as non-discrimination rules, would expose the plan sponsor to significant legal and financial risks. Professionals should approach such decisions by first clearly defining the plan's objectives and the target population for preventive care initiatives. This should be followed by a systematic research and evaluation process, drawing on credible data and expert advice. A cost-benefit analysis, considering both direct and indirect costs and benefits, is crucial. Finally, any proposed strategy must be vetted for regulatory compliance and alignment with the plan's fiduciary responsibilities, ensuring that the ultimate decision serves the best interests of the plan participants and beneficiaries. Question 8. The analysis reveals that a plan sponsor is evaluating several managed care plan options to control rising healthcare expenditures for its employee population. The primary objective is to reduce costs while maintaining a reasonable level of employee satisfaction with healthcare access. Which of the following approaches best aligns with the fiduciary responsibilities of a plan sponsor under U.S. federal law? Option A. Choosing the plan that offers the most administrative ease for the employer's HR department, regardless of its provider network's depth or quality. Option B. Prioritizing a plan that demonstrates a robust provider network with strong quality metrics and a clear, accessible grievance resolution process, even if its premium is slightly higher than other options. Option C. Relying solely on marketing materials and testimonials from other employers to gauge the effectiveness and cost efficiency of a managed care plan. Option D. Selecting the plan with the lowest per member per month premium, assuming it offers a broad range of services. The correct answer is D. Selecting the plan with the lowest per member per month premium, assuming it offers a broad range of services. Explanation. This scenario presents a professional challenge because plan sponsors are increasingly seeking ways to control healthcare costs while ensuring their employees have access to quality care. Evaluating managed care plan options requires a nuanced understanding of their operational structures, network adequacy, and compliance with relevant regulations, particularly the Employee Retirement Income Security Act (ERISA) in the U.S. context, which governs most private employer-sponsored plans. The plan sponsor's fiduciary duty under ERISA necessitates acting prudently and solely in the interest of plan participants and beneficiaries. This involves a thorough due diligence process that goes beyond simply comparing premium costs. The correct approach involves a comprehensive evaluation of the managed care plan's network adequacy, quality of care metrics, and grievance procedures, alongside cost effectiveness. This aligns with the best practice of ensuring that a plan not only manages costs, but also fulfills its obligation to provide access to a sufficient number of qualified healthcare providers and a reasonable standard of care. Regulatory justification stems from ERISA prudence and loyalty standards, which require fiduciaries to act with the care, skill, prudence, and diligence that a prudent person acting in a like capacity and familiar with such matters would use. This includes understanding the practical implications of a plan's design on participant access and outcomes. An incorrect approach would be to solely focus on the lowest premium cost without scrutinizing the provider network. This fails to meet the fiduciary standard because a low premium might be achieved by severely limiting the network, thereby restricting participant access to necessary care and potentially leading to higher out-of-pocket expenses or delayed treatment, which is not in the best interest of participants. Another incorrect approach is to prioritize a plan based on anecdotal evidence or marketing materials without independent verification of its performance metrics or compliance with network adequacy standards. This lacks the diligence required by ERISA and could expose the plan sponsor to legal challenges and participant dissatisfaction. A third incorrect approach is to select a plan that offers extensive administrative convenience to the employer, but demonstrably compromises participant access to care or quality of services. This prioritizes employer convenience over the primary fiduciary responsibility to participants. The professional decision-making process for similar situations should involve a structured due diligence framework. This includes defining clear objectives for the managed care plan, researching potential providers thoroughly, requesting detailed information on network size and geographic distribution, reviewing quality assurance and grievance resolution processes, and assessing the plan's financial stability and regulatory compliance history. Engaging with benefits consultants and legal counsel specializing in ERISA can further support this process, ensuring that all decisions are well documented and defensible. Question 9. Stakeholder feedback indicates a desire to implement stricter prior authorization requirements for all outpatient mental health services to control rising costs. As a certified employee benefit specialist, CEBS, administering this plan, which of the following approaches best ensures compliance with the Mental Health Parity and Addiction Equity Act, MHPA? Option A. Conduct a detailed comparative analysis of the proposed prior authorization requirements for mental health services against the prior authorization requirements for comparable medical/surgical services to determine if a disparity exists and advise the plan sponsor accordingly. Option B. Implement the stricter prior authorization requirements for mental health services only after obtaining a general assurance from the mental health provider network that they can manage the increased administrative burden. Option C. Defer the decision entirely to the plan sponsor, providing them with the cost-saving projections but no specific analysis of MHPA compliance. Option D. Implement the stricter prior authorization requirements for mental health services, assuming that if the plan covers these services, it is compliant with MHPA. The correct answer is D. Implement the stricter prior authorization requirements for mental health services, assuming that if the plan covers these services, it is compliant with MHPA. Explanation: this scenario presents a professional challenge because it requires a benefits administrator to balance the stated needs of plan participants with the operational and financial realities of plan design, all while adhering to complex federal legislation. The Mental Health Parity and Addiction Equity Act, MHPA, mandates that financial and treatment limitations applicable to mental health and substance use disorder, MH/SUD benefits, cannot be more restrictive than those applied to medical/surgical benefits. The challenge lies in interpreting and applying these provisions correctly to avoid discriminatory practices and ensure compliance. Careful judgment is required to assess whether the proposed changes, while seemingly aimed at cost containment, inadvertently create a disparity in access or coverage for MH/SUD services. The correct approach involves a thorough review of the proposed plan design changes against the specific requirements of MHPA. This includes analyzing the network adequacy, prior authorization requirements, and reimbursement rates for MH/SUD providers compared to medical/surgical providers. If the analysis reveals that the proposed changes would impose greater restrictions or limitations on MH/SUD benefits, the administrator must advise against their implementation or recommend modifications to ensure parity. This approach is correct because it directly addresses the core mandate of MHPA: to ensure that MH/SUD benefits are not subject to more restrictive limitations than medical/surgical benefits. Failure to conduct this rigorous comparative analysis would risk violating federal law and potentially lead to significant penalties and reputational damage. An incorrect approach would be to implement the proposed changes solely based on the desire to reduce overall plan costs without a detailed parity analysis. This fails to acknowledge the specific protections afforded by MHPA and assumes that cost savings automatically justify any change in benefit structure. This approach is ethically and regulatorily flawed because it prioritizes financial considerations over legal compliance and the equitable treatment of plan participants with MH/SUD conditions. Another incorrect approach would be to rely on a general understanding of parity without a specific, documented comparison of the proposed MH/SUD limitations against those for medical/surgical benefits. This might involve assuming that because the plan offers some coverage for MH/SUD, it is compliant. This is insufficient because MHPR requires a detailed, quantitative and qualitative comparison of specific limitations, not a broad assumption of compliance. The law demands a granular examination of how each type of benefit is treated. A final incorrect approach would be to defer the decision to the plan sponsor, without providing a clear recommendation based on MHPR requirements. While the plan sponsor ultimately makes decisions, the benefits administrator has a professional responsibility to advise on compliance. Simply passing the decision along without a thorough analysis and recommendation abdicates this responsibility and could lead to the sponsor unknowingly approving a non-compliant plan design. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the request. Clearly identify the proposed changes and their intended impact. 2. Identify relevant regulations. Determine which laws and guidelines apply, in this case MHPA. 3. Conduct a comparative analysis. Systematically compare the proposed MH/SUD benefit limitations, financial treatment network with those for medical/surgical benefits. 4. Assess compliance. Based on the analysis, determine if the proposed changes would violate MHPA. 5. Formulate a recommendation. Advise the plan sponsor on the compliance status and suggest necessary modifications or alternatives. 6. Document the process. Maintain thorough records of the analysis, findings, and recommendations. Question 10. Stakeholder feedback indicates a growing desire among employee benefit plan participants for greater involvement in decisions affecting their retirement and health benefits. As a CEBS professional advising a plan sponsor on a potential significant change to the company's 401(k) plan, which approach best embodies the principles of shared decision-making while adhering to regulatory requirements. Option A. Engage a third-party administrator to independently review the proposed changes and make the final decision based on their expertise, with minimal participant consultation. Option B. Inform participants via a brief company-wide email about the finalized plan changes, directing them to a summary document on the company intranet. Option C. Present the proposed plan changes to participants through a comprehensive webinar series, followed by a dedicated queue and a session and a period for written feedback before the final decision is made. Option D. Conduct a single town hall meeting to announce the proposed changes and immediately solicit a vote from participants on the presented options. The correct answer is C. Present the proposed plan changes to participants through a comprehensive webinar series, followed by a dedicated queue and a session, and a period for written feedback before the final decision is made. Explanation. This scenario is professionally challenging because it requires balancing the fiduciary duty to act in the best interest of plan participants with the practical realities of implementing and communicating complex benefit plan changes. The CEBS professional must navigate potential participant confusion, ensure compliance with ERISA disclosure requirements, and foster trust through transparent communication. Careful judgment is required to select an approach that not only informs, but also empowers participants to make informed decisions about their benefits. The correct approach involves proactively engaging participants in the decision-making process by providing clear, accessible information about the proposed changes and their implications, alongside opportunities for questions and feedback. This aligns with ERISA fiduciary responsibilities, which mandate acting solely in the interest of plan participants and beneficiaries, and with the care, skill, prudence, and diligence that a prudent person acting in a like capacity and familiar with such matters would use. Furthermore, it supports the spirit of shared decision-making by ensuring participants understand their options and can provide input that may influence the final plan design or implementation, thereby promoting informed consent and participant engagement. An incorrect approach that focuses solely on informing participants of a finalized decision without prior engagement fails to uphold the principle of shared decision-making. This approach risks violating ERISA disclosure requirements if the information provided is insufficient or misleading, and it can erode participant trust by making them feel like decisions are imposed rather than collaboratively developed. Another incorrect approach that relies on a single, high-level communication channel, such as a brief email, without offering multiple avenues for interaction or clarification, is inadequate. This overlooks the diverse needs and comprehension levels of participants and may not fulfill the obligation to provide information in a manner that is readily understandable, potentially leading to non-compliance with disclosure regulations and a failure to facilitate genuine shared decision-making. A third incorrect approach that delegates the entire decision-making process to a third-party administrator without adequate oversight or participant input bypasses the plan sponsor's fiduciary responsibilities. While administrators can provide expertise, the ultimate responsibility for plan governance and participant well-being rests with the plan sponsor, who must ensure that decisions are made in the best interest of participants and that communication is effective and compliant. Professionals should employ a decision-making framework that prioritizes understanding participant needs and concerns, thoroughly researching relevant ERISA regulations and best practices for participant communication, and developing a multifaceted engagement strategy. This strategy should include clear, accessible educational materials, multiple feedback channels, and a commitment to incorporating participant input where feasible, all while maintaining fiduciary responsibility. Question 11. Operational review demonstrates that a plan sponsor's pharmacy benefit manager, PBM, contract includes a standard rebate pass-through clause and a fixed dispensing fee. The plan sponsor is considering renewing the contract without further investigation into the specifics of the rebate sharing or the reasonableness of the dispensing fee, believing the current arrangement is typical. Which of the following approaches best aligns with the plan sponsor's fiduciary responsibilities under ERISA? Option A. Assume that standard contract terms for rebate pass-through and dispensing fees are inherently fair and do not require specific scrutiny for this particular plan. Option B. Prioritize the renewal of the contract based on the lowest initial premium cost quoted by the PBM, assuming that this will result in the most cost-effective overall benefit for the plan. Option C. Accept the PBMs attestation that their practices are compliant with all relevant regulations and contractual obligations without independent verification. Option D. Conduct a detailed review of the PBM contract to understand the exact percentage of rebates passed through to the plan, and to assess the reasonableness of the dispensing fees in relation to industry benchmarks and actual costs. The correct answer is D. Conduct a detailed review of the PBM contract to understand the exact percentage of rebates passed through to the plan, and to assess the reasonableness of the dispensing fees in relation to industry benchmarks and actual costs. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a plan sponsor to navigate the complex landscape of pharmacy benefit management, PBM, contracts, and their alignment with fiduciary responsibilities under ERISA. The core challenge lies in ensuring that the PBM's practices, particularly regarding rebates and network dispensing fees, genuinely benefit the plan and its participants, rather than creating hidden profits for the PBM at the expense of the plan. This necessitates a deep understanding of PBM operations and a commitment to rigorous oversight to uphold fiduciary duties. Correct approach analysis. The correct approach involves conducting a thorough review of the PBM contract, focusing on transparency in rebate sharing and the reasonableness of dispensing fees. This aligns with ERISA requirement for fiduciaries to act solely in the interest of plan participants and beneficiaries, and with the exclusive purpose of providing benefits and defraying reasonable expenses of administration. Specifically, ERISA Section 404A, 1A and B mandate that fiduciaries act prudently and in the best interest of the plan. A fiduciary duty exists to ensure that all fees and arrangements are reasonable and for the benefit of the plan. Negotiating for a pass-through of a significant portion of rebates and scrutinizing dispensing fees to ensure they reflect actual costs and are not inflated are critical steps in fulfilling this duty. This proactive stance demonstrates a commitment to cost containment and value for the plan. Incorrect approach is analysis. An approach that relies solely on the PBM's attestation of compliance without independent verification fails to meet the prudent standard under ERISA. Fiduciaries cannot delegate their oversight responsibilities entirely. they must exercise independent judgment and conduct due diligence. This approach risks overlooking potential conflicts of interest or undisclosed revenue streams that may not be in the plan's best interest. An approach that prioritizes the lowest initial premium cost without examining the underlying PBM contract terms, such as rebate sharing and dispensing fees, is also flawed. While cost is a factor, it is not the sole determinant of a prudent decision. ERISA requires fiduciaries to consider the overall value and reasonableness of services provided, not just the sticker price. Hidden costs or less favorable rebate arrangements can negate apparent savings. An approach that assumes all PBM contracts are standard and therefore require no specific scrutiny of rebate pass-throughs or dispensing fees is a failure of due diligence. PBM contracts can vary significantly, and a one-size-fits-all mentality can lead to suboptimal outcomes for the plan. Each contract should be evaluated based on its specific terms and the PBM's operational practices. Professional reasoning. Professionals should approach PBM oversight by first understanding the fiduciary obligations under ERISA. This involves a commitment to prudence, loyalty, and acting solely in the interest of plan participants. The decision-making process should begin with a comprehensive review of the PBM contract, seeking clarity on all financial arrangements, including rebate sharing methodologies and dispensing fee structures. Independent analysis and, if necessary, expert consultation should be employed to validate the reasonableness of these terms. The ultimate goal is to ensure that the PBM services provide demonstrable value to the plan and its members, aligning with the fiduciary's duty to secure the best possible outcomes for the plan's assets. Question 12. Compliance review shows that an employer has established a health reimbursement arrangement, HRA, that allows employees to receive reimbursement for premiums paid for individual health insurance policies, in addition to other qualified medical expenses. Which of the following approaches best ensures the HRA remains compliant with IRS regulations? Option A. The HRA is designed to reimburse only qualified medical expenses incurred by employees, their spouses, and dependents, and is integrated with the employer's group health plan. Option B. The HRA is modified to reimburse premiums paid for individual health insurance policies, as this provides employees with greater flexibility in choosing their health coverage. Option C. The HRA is allowed to reimburse expenses incurred by any individual designated by the employee, regardless of their relationship to the employee or their status as a dependent. Option D. The HRA is offered as a standalone benefit, providing reimbursements for a broad range of expenses without requiring integration with any other employer-sponsored health plan. The correct answer is A. The HRA is designed to reimburse only qualified medical expenses incurred by employees, their spouses, and dependents, and is integrated with the employer's group health plan. Explanation. This scenario presents a common challenge in employee benefits administration, ensuring that a health reimbursement arrangement, HRA, complies with IRS regulations, specifically regarding its integration with other health coverage. The professional challenge lies in understanding the nuances of HRA design and operation to avoid disqualification, which could lead to adverse tax consequences for both the employer and the employee. Careful judgment is required to interpret IRS guidance and apply it to the specific facts of the HRA's setup. The correct approach involves ensuring the HRA is integrated with a qualified health plan, meaning it is not considered an accepted benefit and is therefore subject to the Affordable Care Act, ACA, employer shared responsibility provisions, and other applicable regulations. This integration is crucial for maintaining the HRA's tax-favored status. The HRA must be established and maintained by the employer, and it must be used to reimburse medical expenses incurred by employees, their spouses, and dependents. The key is that the HRA is not a standalone plan and is tied to other employer-sponsored health coverage. An incorrect approach would be to allow the HRA to be used to reimburse premiums for individual health insurance policies. This is generally prohibited by IRS regulations for HRAs integrated with employer-sponsored health coverage, as it can cause the HRA to be treated as an employer payment of individual health insurance premiums, which is a taxable benefit and can lead to penalties under the ACA. Another incorrect approach would be to permit the HRA to reimburse expenses incurred by individuals who are not employees, their spouses, or dependents. HRAs are designed to provide benefits to employees and their eligible family members. Extending benefits to non-eligible individuals would violate the terms of the HRA and potentially IRS rules regarding eligible beneficiaries. A third incorrect approach would be to allow the HRA to be offered as a standalone benefit without being integrated with any other employer-sponsored health plan. While some limited HRAs exist, the typical HRA, especially one subject to ACA employer mandate considerations, must be integrated with a group health plan. Offering it as a standalone benefit without proper design and integration could lead to it being classified as taxable compensation or an invalid health plan. The professional decision-making process for similar situations should begin with a thorough understanding of the specific type of HRA being administered and its intended purpose. This involves consulting the HRA plan document and relevant IRS guidance, particularly regarding integration with other health coverage and eligible expenses/beneficiaries. When in doubt, seeking clarification from legal counsel or a qualified benefits consultant specializing in HRAs is essential to ensure compliance and avoid potential penalties. The focus should always be on adhering to the regulatory framework that governs HRAs to maintain their tax advantage status and ensure they provide the intended benefits to eligible employees. Question 13. Consider a scenario where a large employer sponsoring a self-funded group health plan, subject to ERISA, is exploring ways to manage rising prescription drug costs. The plan's benefits committee has been presented with findings from several independent comparative effectiveness research studies that suggest a newer, more expensive biologic drug offers only marginal clinical benefits over an older, less expensive generic alternative for a specific chronic condition prevalent among the plan's employee population. The committee is tasked with deciding whether to continue covering both drugs equally, restrict coverage of the newer drug, or implement a step therapy protocol that requires participants to try the generic first. Which approach best aligns with the fiduciary responsibilities of the plan sponsor under ERISA? Option A. Immediately remove coverage for the newer biologic drug from the plan, citing the CER findings that it offers only marginal benefits to achieve significant cost savings for the plan. Option B. Continue covering both the newer biologic drug and the older generic alternative equally without modification, to avoid any potential perception of limiting participant choice or access to care, regardless of cost implications or CER findings. Option C. Rely solely on the recommendations of the pharmaceutical manufacturer of the newer biologic drug, who claims their product has superior long-term outcomes not fully captured by independent CER, and maintain equal coverage for both drugs. Option D. Implement a step therapy protocol that requires participants to first try the less expensive generic drug, supported by CER findings indicating similar efficacy for the majority of patients, while ensuring a clear and accessible process for participants to request an exception for the newer biologic drug based on medical necessity, with a documented review process. The correct answer is D. Implement a step therapy protocol that requires participants to first try the less expensive generic drug, supported by CER findings indicating similar efficacy for the majority of patients, while ensuring a clear and accessible process for participants to request an exception for the newer biologic drug based on medical necessity, with a documented review process. Explanation. This scenario is professionally challenging because it requires a benefits professional to navigate the complex landscape of evidence-based decision-making for plan design and cost containment, while adhering strictly to the fiduciary duties and regulatory requirements governing employee benefit plans in the United States. The core challenge lies in balancing the desire to improve health outcomes and manage costs with the legal and ethical obligations to act solely in the best interest of plan participants and beneficiaries. The professional must understand that while comparative effectiveness research, offers valuable insights, its application must be grounded in a thorough understanding of ERISA prudence and loyalty standards. The correct approach involves a systematic and documented process of evaluating CER findings in the context of the specific plan's demographics, existing benefits, and overall cost-effectiveness. This includes considering the quality and applicability of the research, the potential impact on participant access to care, and the long-term financial sustainability of any proposed changes. The fiduciary duty of prudence requires plan sponsors and their advisors to act with the care, skill, and diligence that a prudent person acting in a like capacity and familiar with such matters would use. The duty of loyalty mandates that fiduciaries act solely in the interest of participants and beneficiaries. Therefore, incorporating CER findings must be part of a comprehensive, well-documented process that demonstrates a diligent effort to secure the best possible benefits for participants at a reasonable cost, without introducing undue risk or limiting access to medically necessary care without a sound, evidence-based rationale. An incorrect approach would be to unilaterally adopt recommendations from CER without a thorough, plan-specific evaluation. This could lead to a breach of fiduciary duty because it fails to demonstrate the required prudence and diligence. For instance, implementing a change based solely on a CER study that shows marginal cost savings but significantly restricts access to a proven treatment for a substantial portion of the plan's population would likely violate the duty of loyalty, as it prioritizes cost reduction over participant well-being. Another incorrect approach is to ignore CER findings altogether. This could be seen as a failure of prudence, as it neglects a valuable source of information that could lead to more effective and efficient benefit design, potentially resulting in higher costs for the plan and its participants over time. Finally, relying on anecdotal evidence or vendor-specific claims rather than robust, independent CER would also be a failure of prudence, as it lacks the objective, evidence-based foundation required for sound fiduciary decision-making. The professional decision-making process in such situations should involve a structured approach. 1. Identify the objective. What problem is the plan trying to solve, e.g., rising costs, suboptimal outcomes for a specific condition? 2. Gather relevant information. This includes reviewing available CER, consulting with medical experts, and analyzing plan utilization data. 3. Evaluate the evidence. Critically assess the quality, relevance, and applicability of CER findings to the specific plan population. 4. Consider alternatives. Explore various options for addressing the objective, including potential changes to coverage, provider networks, or wellness programs. 5. Analyze the impact. Assess the potential financial, clinical, and participant access implications of each alternative. 6. Document the process. Maintain thorough records of the research, analysis, and decision-making rationale. 7. Seek expert advice. Consult with legal counsel and benefits consultants to ensure compliance with ERISA and other applicable laws. 8. Make a prudent decision. Choose the option that best serves the interests of participants and beneficiaries, considering both cost and quality of care. Question 14. The efficiency study reveals that sharing employee benefits data with a new third-party administrator could streamline claims processing and reduce administrative costs. However, the proposed administrator has not provided detailed documentation regarding their data security protocols or a signed business associate agreement. Which of the following represents the most appropriate best practice approach for a CEBS professional in this situation? Option A. Share only aggregated, non-identifiable data with the third-party administrator to mitigate privacy risks, even if it limits the efficiency gains identified in the study. Option B. Delay data sharing until a comprehensive risk assessment is completed, a business associate agreement is executed, and the third-party administrator demonstrates adherence to robust data security standards, including encryption and access controls. Option C. Inform the employees that their data will be shared to improve efficiency, assuming their consent is implied by their participation in the benefits plan. Option D. Proceed with data sharing after obtaining informal assurances from the third-party administrator regarding their data security measures, emphasizing the significant cost savings. The correct answer is D. Proceed with data sharing after obtaining informal assurances from the third-party administrator regarding their data security measures, emphasizing the significant cost savings. Explanation. This scenario presents a professional challenge because it requires balancing the operational benefits of data sharing with the stringent legal and ethical obligations to protect sensitive employee information. The Certified Employee Benefit Specialist (CEBS) designation implies a commitment to upholding the highest standards of data privacy and security, particularly when dealing with personal health information, (FI), and other confidential employee data. The CEBS professional must navigate complex regulatory landscapes, such as the Health Insurance Portability and Accountability Act, HIPAA, in the U.S., to ensure compliance and maintain participant trust. Careful judgment is required to assess the risks associated with data sharing and implement appropriate safeguards. The correct approach involves a comprehensive risk assessment and the implementation of robust data security measures before any data sharing occurs. This includes ensuring that any third-party vendor or partner has undergone a thorough due diligence process, has signed a business associate agreement, BA, if required by HIPAA, and adheres to strict data encryption, access control, and breach notification protocols. This proactive and compliant strategy aligns with the core principles of data protection mandated by regulations like HIPAA, which emphasizes the need for appropriate administrative, physical, and technical safeguards to protect electronic protected health information (EFI). Ethical considerations also dictate that participant data is handled with the utmost care and confidentiality, prioritizing their privacy over mere operational convenience. An incorrect approach would be to proceed with data sharing based solely on the perceived efficiency gains, without verifying the security protocols of the receiving entity. This failure to conduct due diligence and establish contractual safeguards, such as a BAA, directly violates HIPAA security rule, which mandates covered entities and their business associates to implement security measures to protect EPHI. Another incorrect approach would be to share data without anonymizing or de-identifying it, thereby exposing sensitive employee information and increasing the risk of a data breach. This disregard for privacy protections is a significant ethical and regulatory failure. Furthermore, relying on informal assurances of data security from a partner, without documented agreements and audit trails, demonstrates a lack of professional rigor and exposes the organization to substantial legal and reputational risks. The professional decision-making process for similar situations should begin with a thorough understanding of all applicable data privacy regulations. This should be followed by a comprehensive risk assessment that identifies potential vulnerabilities and threats to sensitive data, implementing a layered security approach, including technical safeguards, e.g., encryption access controls, physical safeguards, e.g., secure data centers, and administrative safeguards, e.g., policies, training, BA, is crucial. Regular audits and reviews of security practices, both internal and with third-party vendors, are essential to ensure ongoing compliance and to adapt to evolving threats. Prioritizing participant privacy and data security, even when it may present operational challenges, is paramount for maintaining trust and upholding professional integrity. Question 15. Market research demonstrates that a multinational corporation is experiencing increasing complexity in managing its global health benefits program due to diverse regulatory environments and employee expectations across its operating regions. The company's senior leadership is seeking a strategic approach to ensure compliance, equity, and effectiveness of its health benefits offerings worldwide. Which of the following approaches best aligns with best practices for global health benefits management within a regulated framework? Option A. Delegate complete authority for health benefits design and administration to individual country managers, allowing them to create programs that best suit their local market conditions and legal obligations without central oversight. Option B. Focus primarily on cost containment by offering the most basic level of health coverage globally that is legally permissible in the least regulated country, with minimal additional benefits to reduce overall expenditure. Option C. Implement a single, standardized global health benefits package across all countries to ensure absolute equity and simplify administration, regardless of local legal requirements or healthcare system variations. Option D. Develop a global minimum standard for health benefits that all employees receive, and then customize benefits in each country to meet specific legal mandates, address prevalent local health concerns, and align with prevailing employee expectations, while ensuring overall program coherence. The correct answer is D. Develop a global minimum standard for health benefits that all employees receive, and then customize benefits in each country to meet specific legal mandates, address prevalent local health concerns, and align with prevailing employee expectations, while ensuring overall program coherence. Explanation. This scenario is professionally challenging because a global benefits manager must navigate a complex web of differing national regulations, cultural expectations, and varying healthcare system structures when designing and administering health benefits for a multinational workforce. The core challenge lies in balancing the need for a globally consistent benefits philosophy with the imperative to comply with local laws and meet the diverse needs of employees in different countries. Careful judgment is required to ensure that the benefits offered are both legally compliant and perceived as equitable and valuable by employees across all operating regions. The correct approach involves a tiered strategy that prioritizes compliance and essential coverage while allowing for local adaptation. This approach begins with establishing a global minimum standard for health benefits, ensuring that all employees receive a baseline level of protection that aligns with international best practices and any overarching corporate social responsibility commitments. Subsequently, it mandates thorough research into the specific legal requirements, healthcare infrastructure, and prevailing employee expectations in each country of operation. This allows for the customization of benefits to meet local mandates, e.g., mandatory social health insurance contributions, specific coverage requirements, and to address prevalent health concerns or cultural norms within that region. This approach is ethically sound and legally defensible, as it demonstrates a commitment to both global consistency and local responsibility, thereby fostering employee trust and mitigating legal risks. An incorrect approach that focuses solely on a uniform global benefit package without regard for local laws would fail to meet mandatory coverage requirements in many jurisdictions, leading to legal penalties, fines, and potential litigation. This approach also ignores the practical realities of healthcare access and affordability in different countries, potentially offering benefits that are either inadequate or unnecessarily expensive. Another incorrect approach that delegates all health benefit decisions to local country managers without any central oversight or global framework risks creating significant disparities in coverage and cost across the organization. It might ensure local compliance. It could lead to inequitable treatment of employees, brand damage due to perceived unfairness, and a lack of strategic alignment with the company's overall benefits philosophy and financial objectives. This approach also misses opportunities for economies of scale in global procurement or risk pooling. A third incorrect approach that prioritizes cost savings above all else, even if it means offering minimal or substandard coverage, would likely be ethically questionable and could lead to significant employee dissatisfaction and potential legal challenges if it falls below legally mandated minimums. While cost management is important, it cannot supersede legal obligations and the fundamental responsibility to provide adequate health protection. The professional decision-making process for such situations should involve a structured framework. 1. Understand the global context. Define the company's overarching philosophy and objectives for global health benefits. 2. Identify legal and regulatory landscapes. Conduct comprehensive research into the specific legal requirements and healthcare systems of each country. 3. Assess employee needs and expectations. Gather insights into what employees value and require in terms of health coverage in their respective locations. 4. Develop a tiered strategy. Design a core global standard with flexibility for local adaptation to meet legal mandates and specific needs. 5. Implement and monitor. Roll out the benefits program with clear communication and establish mechanisms for ongoing review and adjustment based on legal changes, market trends, and employee feedback. 6. Seek expert advice. Engage local legal counsel and benefits consultants in each jurisdiction to ensure accuracy and compliance. Question 16. Operational review demonstrates that an employer is considering implementing a new patient advocacy program designed to help employees navigate complex healthcare decisions and potentially reduce overall healthcare costs for the plan. What is the most prudent approach for the plan administrator to ensure this program aligns with their fiduciary responsibilities under ERISA and enhances, rather than hinders, participant access to benefits? Option A. Focus solely on the program's ability to negotiate lower prices for services, as this directly contributes to cost containment, which is a primary fiduciary duty. Option B. Conduct a thorough assessment of the program's design and operational procedures to ensure it facilitates participant access to medically necessary care and complies with all ERISA requirements for claims adjudication and disclosure, and seek legal counsel to review the program's structure and materials. Option C. Implement the program immediately, focusing on its cost-saving potential, and address any participant access issues as they arise. Option D. Delegate the entire responsibility for the program's design and oversight to the third-party vendor offering the patient advocacy services, assuming their expertise will ensure compliance. Correct answer is C. Implement the program immediately, focusing on its cost-saving potential, and address any participant access issues as they arise. Explanation. This scenario presents a professional challenge because it requires balancing the employer's desire for cost containment with the employee's fundamental right to access necessary healthcare services and the fiduciary duty of the plan administrator. The complexity arises from the potential for a patient advocacy program, while beneficial, to inadvertently create barriers or delays in care if not implemented with careful consideration of regulatory requirements and ethical obligations. The plan administrator must ensure that any such program supports, rather than hinders, participants' access to benefits as defined by the plan documents and ERISA. The correct approach involves proactively identifying and addressing potential barriers to care that a patient advocacy program might introduce. This means ensuring the program's design and operation align with ERISA fiduciary duties, particularly the duty of loyalty and the duty to act solely in the interest of plan participants and beneficiaries. Specifically, the program must not create undue burdens or delays in obtaining pre-authorization or appeals, and it must provide clear, accessible information to participants about their rights and the program's services. The regulatory framework, primarily ERISA, mandates that plan fiduciaries act prudently and in the best interest of participants. A patient advocacy program, if structured to facilitate navigation of complex healthcare systems and benefit claims, can be a valuable tool that supports these duties by enhancing participant understanding and access. An incorrect approach would be to implement a patient advocacy program without a thorough review of its potential impact on participant access to care, and without ensuring compliance with ERISA disclosure and claims adjudication requirements. For instance, a program that prioritizes cost savings over timely access to medically necessary services would violate the fiduciary duty of loyalty. Another failure would be to implement a program that creates additional, uncommunicated hoops for participants to jump through to access benefits, thereby potentially violating ERISA requirements for clear communication and fair claims handling. Furthermore, a program that does not adequately train its advocates on ERISA provisions and the specific terms of the employer's benefit plan risks providing inaccurate guidance, leading to participant harm and potential legal liability for the plan sponsor and administrator. Professionals should approach such situations by first conducting a comprehensive impact assessment of any proposed program on participant access and rights. This assessment should involve reviewing the program's operational procedures, communication strategies, and alignment with ERISA fiduciary responsibilities and participant protections. A key step is to ensure that the program's objectives are clearly defined and that these objectives are consistent with the plan's purpose of providing benefits. Engaging legal counsel specializing in employee benefits law is crucial to ensure all aspects of the program comply with the complex regulatory landscape. Continuous monitoring and evaluation of the program's effectiveness and participant satisfaction are also essential to identify and rectify any unintended negative consequences. Question 17. Market research demonstrates that a mid-sized employer is considering significant changes to its group health insurance plan to reduce its annual premium costs. The proposed changes include increasing deductibles and co-pays across all tiers of coverage and introducing a new, lower-tier plan option with a higher deductible and more limited network of providers. The employer's primary objective is to achieve a 15% reduction in their overall health insurance expenditure. As the benefits administrator, what is the most prudent approach to advise the employer regarding these proposed changes, considering the regulatory framework governing employer-sponsored health plans? Option A. Inform the employer that the proposed changes are acceptable as long as they are clearly communicated to employees, and that employees can seek alternative coverage if they are dissatisfied. Option B. Advise the employer to proceed with the proposed plan changes, as cost reduction is a primary business objective, and the employer has the right to design its benefits package. Option C. Conduct a detailed analysis of the proposed plan design to assess its compliance with the Affordable Care Act's employer shared responsibility provisions, including affordability safe harbors and minimum value requirements, and advise on potential risks and necessary adjustments. Option D. Recommend that the employer adopt a plan design similar to that of a competitor in their industry that has recently reported significant cost savings, assuming their plan is compliant. The correct answer is B. Advise the employer to proceed with the proposed plan changes, as cost reduction is a primary business objective, and the employer has the right to design its benefits package. Explanation. This scenario is professionally challenging because it requires a benefits administrator to balance the employer's desire to control costs with the legal obligations and ethical responsibilities to provide compliant and adequate health coverage under the Affordable Care Act, ACA. The administrator must navigate complex regulations to ensure the employer's plan design does not inadvertently create affordability issues or fail to meet minimum value standards, which could lead to penalties. Careful judgment is required to assess the risk of non-compliance and its potential financial and reputational consequences for the employer. The correct approach involves a thorough review of the proposed plan design against the ACA's employer shared responsibility provisions, specifically focusing on the affordability safe harbors and the minimum value requirement. This proactive assessment ensures that the plan, as designed, is likely to be considered affordable and provide minimum value, thereby avoiding potential penalties. This aligns with the administrator's ethical duty to act in the best interest of both the employer and the employees by ensuring compliance and preventing adverse outcomes. An incorrect approach that focuses solely on the employer's cost-saving goals without a comprehensive regulatory review risks violating the ACA. For instance, simply implementing a high-deductible plan without verifying if it meets the affordability safe harbor thresholds, based on the federal poverty line for self-only coverage, could lead to the employer being subject to penalties if any full-time employee receives a premium tax credit. Another incorrect approach, which involves assuming that any plan offering a deductible is sufficient, fails to consider the minimum value requirement, which mandates that the plan must cover at least 60% of the total allowed cost of benefits. Failing to meet this standard also exposes the employer to penalties. A third incorrect approach, which relies on anecdotal evidence or competitor plan designs without specific regulatory analysis, is inherently risky as it does not guarantee compliance with the specific requirements of the ACA. Professionals should employ a systematic risk assessment process. This involves identifying all relevant regulatory requirements, ACA employer shared responsibility, state mandates, etc. Evaluating the proposed plan design against each requirement, assessing the potential financial and legal consequences of non-compliance, and recommending adjustments to mitigate identified risks. This process should be documented to demonstrate due diligence. Question 18. The monitoring system demonstrates a significant increase in employee utilization of a new telehealth platform offering mental health support, which was recently introduced as a pilot program. The platform boasts advanced AI-driven personalized care plans and direct access to a wider network of specialists. However, preliminary data also indicates a slight uptick in overall plan costs, primarily due to increased utilization of these specialized services. As the plan administrator, what is the most prudent and compliant approach to evaluating this innovation? Option A. Immediately discontinue the pilot program due to the observed increase in overall plan costs, prioritizing short-term cost containment over potential long-term benefits or employee satisfaction. Option B. Conduct a thorough, data-driven evaluation of the telehealth platform's effectiveness, cost efficiency, and compliance with ERISA fiduciary standards, including a detailed analysis of utilization patterns, cost drivers, and participant outcomes, before making a decision on its continuation or expansion. Option C. Expand the telehealth platform to all eligible employees immediately, based on the strong initial employee engagement, and address any cost concerns through future plan design adjustments. Option D. Continue the pilot program as is, focusing on the positive employee engagement metrics and assuming long-term cost benefits will materialize, while deferring a detailed cost-benefit analysis until the pilot concludes. The correct answer is D. Continue the pilot program as is, focusing on the positive employee engagement metrics and assuming long-term cost benefits will materialize, while deferring a detailed cost-benefit analysis until the pilot concludes. Explanation. This scenario presents a professional challenge because it requires a benefits administrator to evaluate the effectiveness and compliance of innovative healthcare solutions within the strict confines of U.S. ERISA, Employee Retirement Income Security Act, regulations, and related guidance. The administrator must balance the desire to offer cutting-edge benefits that could improve employee health and potentially reduce long-term costs with the fiduciary duty to ensure these innovations are prudent, cost-effective, and do not violate ERISA requirements for plan administration and participant protections. The challenge lies in discerning genuine innovation from unproven or potentially non-compliant offerings, necessitating a rigorous evaluation process. The correct approach involves a comprehensive assessment of the proposed healthcare innovation against established ERISA fiduciary standards and relevant Department of Labor (DOL) guidance. This includes verifying the innovation's alignment with the plan's stated objectives, evaluating its cost-effectiveness through objective data and projections, ensuring transparency in its implementation and impact on participants, and confirming that any third-party vendors involved are acting in the best interest of plan participants and beneficiaries. This approach is justified by ERISA requirement for fiduciaries to act solely in the interest of participants and beneficiaries, and with the care, skill, prudence, and diligence that prudent person acting in a like capacity and familiar with such matters would use in the conduct of an enterprise of a like character and with like aims. Specifically, DOL guidance on fiduciary responsibilities emphasizes the need for thorough due diligence, objective analysis, and ongoing monitoring of plan investments and services. An incorrect approach that focuses solely on the potential for cost savings without a thorough evaluation of participant impact or regulatory compliance would fail to meet ERISA fiduciary standards. This is because ERISA mandates that cost savings cannot come at the expense of participant well-being or by offering services that are not prudent or in the best interest of the plan. Another incorrect approach that prioritizes the cutting-edge nature of the innovation without objective data on its efficacy or cost-effectiveness would also be a violation. This overlooks the fiduciary duty to act prudently and requires evidence-based decision-making, not just adoption of novelties. Finally, an approach that bypasses a review of vendor contracts and service agreements for compliance and participant protections would be a significant ethical and regulatory failure. ERISA requires fiduciaries to ensure that all service providers to the plan are acting in the best interest of the plan and its participants, which necessitates a review of their contractual obligations and adherence to fiduciary principles. Professionals should employ a systematic decision-making process that begins with clearly defining the plan's objectives and the problem the innovation aims to solve. This should be followed by a comprehensive due diligence process that includes researching the innovation's track record, seeking independent expert opinions, analyzing cost-benefit projections with sensitivity testing, and thoroughly reviewing vendor qualifications and contractual terms. The process must also include a plan for ongoing monitoring and evaluation of the innovation's performance against predefined metrics and its continued compliance with ERISA. Question 19. Benchmark analysis indicates that a health plan's quality improvement program has launched several new initiatives over the past year. As a benefits administrator, which of the following approaches best evaluates the effectiveness of these initiatives in enhancing participant health outcomes and plan value? Option A. Focusing primarily on the percentage reduction in overall healthcare claims costs achieved through the new initiatives. Option B. Analyzing provider satisfaction scores and the perceived ease of administrative processes for healthcare providers. Option C. Reviewing the number of new quality initiatives implemented and the total expenditure on these programs. Option D. Examining the plan's utilization of evidence-based clinical guidelines in developing interventions and assessing the impact of these interventions on key patient health metrics and participant satisfaction surveys. The correct answer is C. Reviewing the number of new quality initiatives implemented and the total expenditure on these programs. Explanation. This scenario presents a professional challenge because it requires a benefits administrator to evaluate the effectiveness of a health plan's quality improvement initiatives without relying solely on easily quantifiable metrics. The administrator must discern between superficial reporting and genuine, impactful quality enhancements, which demands a nuanced understanding of healthcare quality principles and their practical application within the regulatory framework governing employee benefit plans in the United States. Careful judgment is required to ensure that the plan is not only meeting minimum standards, but is actively striving for better patient outcomes and cost efficiency, aligning with fiduciary responsibilities. The correct approach involves a comprehensive review of the health plan's quality improvement program, focusing on the integration of clinical evidence, patient feedback, and process improvements. This method is best professional practice because it directly addresses the core tenets of healthcare quality as understood within the U.S. regulatory landscape, such as those emphasized by the Affordable Care Act, ACA, and guidance from the Department of Labor (DOL) regarding fiduciary duties. By examining how the plan uses data to identify care gaps, implement evidence-based interventions, and measure their impact on patient health and satisfaction, the administrator is fulfilling their obligation to ensure the plan provides value and promotes the well-being of participants. This proactive and data-driven evaluation aligns with the expectation that plan fiduciaries act in the best interest of beneficiaries. An incorrect approach that focuses solely on the number of quality initiatives implemented without assessing their effectiveness or impact is professionally unacceptable. This fails to meet the fiduciary standard of care, as it prioritizes activity over outcomes. Such an approach could lead to the continuation of ineffective programs, wasting plan assets, and failing to improve participant health. It also risks noncompliance with regulations that implicitly or explicitly require demonstrable progress in quality of care. Another incorrect approach that relies exclusively on provider satisfaction surveys without correlating them to patient outcomes or cost-effectiveness is also flawed. While provider input is valuable, it is insufficient on its own to gauge the true quality of care delivered. This approach neglects the primary beneficiary of the health plan, the employee, and can overlook critical issues affecting patient health and financial sustainability. It may also fail to identify areas where providers are satisfied, but patient care is suboptimal or unnecessarily expensive. A third incorrect approach that prioritizes cost reduction above all else, even at the potential expense of quality, is ethically and regulatorily problematic. While cost management is a component of responsible plan administration, it cannot supersede the fundamental obligation to provide access to quality health care. Regulations and ethical guidelines emphasize a balance, ensuring that cost-saving measures do not compromise the health and safety of plan participants. This approach risks violating ERISA prudence and loyalty standards by potentially offering less effective or accessible care to participants. The professional decision-making process for similar situations should involve a systematic evaluation of quality improvement efforts. This includes understanding the plan's stated quality goals, reviewing the data and methodologies used to track progress, assessing the impact on patient outcomes and satisfaction, and ensuring alignment with relevant U.S. healthcare regulations and fiduciary responsibilities. Professionals should always ask, does this initiative demonstrably improve the health and well-being of our plan participants in a cost-effective manner, and is it supported by evidence and best practices? Question 20. The risk matrix shows an upward trend in claims costs and administrative overhead for the company's traditional indemnity health plan. As the benefits administrator, which process optimization strategy best aligns with fiduciary responsibilities under ERISA to ensure the long-term viability and participant benefit of the plan? Option A. Discontinuing the indemnity plan in favor of a less flexible, more restrictive managed care option without adequate participant consultation or transition planning. Option B. Implementing a comprehensive review of claims processing workflows to identify and eliminate inefficiencies, enhancing provider contract terms to include performance-based incentives, and developing clearer participant communication materials regarding coverage and cost-sharing. Option C. Increasing participant deductibles and co-payments significantly to offset rising claims costs without exploring other cost containment measures. Option D. Reducing provider reimbursement rates across the board without a detailed analysis of the impact on provider network adequacy or quality of care. The correct answer is B. Implementing a comprehensive review of claims processing workflows to identify and eliminate inefficiencies, enhancing provider contract terms to include performance-based incentives, and developing clearer participant communication materials regarding coverage and cost-sharing. Explanation. This scenario is professionally challenging because it requires a benefits administrator to balance the fiduciary duty to act in the best interest of plan participants with the practical realities of managing plan costs and ensuring compliance with ERISA reporting and disclosure requirements. The administrator must navigate the complexities of a traditional indemnity plan, which, while offering flexibility, can be prone to unpredictable costs and administrative burdens. The core challenge lies in optimizing processes to mitigate these risks without compromising participant benefits or violating regulatory mandates. The correct approach involves proactively identifying and addressing potential cost escalations and administrative inefficiencies inherent in traditional indemnity plans. This includes implementing robust claims review processes, negotiating effectively with providers, and ensuring clear communication with participants regarding coverage limitations and out-of-pocket expenses. This approach aligns with ERISA requirement for fiduciaries to act prudently and solely in the interest of plan participants and beneficiaries. Specifically, ERISA Section 404A 1 mandates that fiduciaries discharge their duties solely in the interest of the plan and with the care, skill, prudence, and diligence that a prudent person acting in a like capacity and familiar with such matters would use. By focusing on process optimization, the administrator is demonstrating this prudence by actively managing plan assets and operations to ensure long-term sustainability and participant well-being. An incorrect approach would be to simply accept the rising claims costs without investigation, assuming it is an unavoidable consequence of the indemnity plan structure. This passive stance fails to meet the fiduciary standard of prudence and diligence. It could lead to the erosion of plan assets and potentially necessitate future benefit reductions or increased participant contributions, which would be detrimental to participants and could be viewed as a breach of fiduciary duty. Another incorrect approach would be to implement cost containment measures that are not clearly communicated to participants or that inadvertently create barriers to accessing necessary care. For example, imposing arbitrary pre-authorization requirements on services that were previously not subject to such scrutiny without adequate notice could violate ERISA disclosure requirements and negatively impact participant access to benefits, thereby failing the fiduciary duty to act solely in the interest of participants. A third incorrect approach would be to prioritize provider negotiations solely on the lowest possible reimbursement rates, without considering the quality of care or the potential for increased utilization due to less experienced providers. This could lead to suboptimal health outcomes for participants, and in the long run, potentially higher overall healthcare costs due to complications or the need for further treatment. This approach would also fail to meet the prudence standard by not considering all relevant factors in cost management. Professional decision-making in such situations requires a systematic evaluation of the plan's performance against its objectives and regulatory requirements. This involves regular monitoring of claims data, provider performance, and participant feedback. When potential issues arise, such as increasing costs or administrative bottlenecks, the administrator should engage in a thorough analysis to identify root causes and develop targeted solutions. This process should involve consulting with relevant experts, such as actuaries or legal counsel, to ensure compliance and best practices. Communication with plan sponsors and participants is also crucial to maintain transparency and manage expectations. The ultimate goal is to optimize the plan's operation to provide valuable benefits to participants in a cost-effective and compliant manner.